In the world of trading, risk is an inherent part of the game. Every time you enter a trade, you're making a calculated bet on the future direction of an asset's price. Effective risk management is about mitigating risk to protect your capital and ensure the longevity of your trading journey. One of the most fundamental tools in a trader's risk management arsenal is the stop-loss order. This tool acts as a safety net, automatically closing your trade when the market moves against your position beyond a predetermined level. Equally important is the take-profit order, which serves as an automated profit-taking mechanism. By understanding and effectively utilizing stop-loss and take-profit orders, traders can gain greater control over their trading outcomes. This systematic approach helps preserve your capital during losing streaks and ensures you lock in profits when your trades go as planned. Whether you're a novice trader or a seasoned investor, mastering these risk management tools is essential for achieving consistent success in the markets. A stop-loss order is a crucial tool designed to limit potential losses on a trade. It acts as a safety net, automatically selling an asset when its price falls to or below a predetermined level. This predetermined level, known as the stop-loss price, is set by the trader based on their risk tolerance and market analysis. In the heat of the moment, when a trade is moving against you, it can be tempting to hold on in the hope that the market will reverse. However, this hope can often lead to greater losses. A stop-loss order eliminates this emotional trap by automatically exiting the trade when the predetermined loss limit is reached. This disciplined approach to risk management is essential for preserving capital and ensuring the longevity of a trading account. Even in scenarios where the market gaps down, stop-loss orders still serve their primary purpose of limiting potential losses and protecting the trader's capital. Understanding the mechanics of stop-loss orders is crucial for their effective implementation. Once you've identified a trade setup and determined your entry point, the next critical step is to set your stop-loss level. There are various methods traders use to determine the optimal stop-loss placement. One common approach is to set the stop-loss order just below a recent support level for long positions or above a recent resistance level for short positions. Another popular method is to use a percentage-based stop-loss. This involves setting the stop-loss a certain percentage away from the entry price based on the trader's risk tolerance. The choice of stop-loss placement method often depends on the trader's individual trading style, risk tolerance, and the specific asset being traded. Setting the stop-loss too tight can lead to premature exits from potentially profitable trades, while setting it too loose can expose you to larger losses. Striking the right balance between protecting your capital and allowing your trades room to breathe is key to successful stop-loss implementation. Let's illustrate the concept of a stop-loss order with a practical example. Imagine you are a trader who has been following the price movements of Apple stock, AAPL. After conducting your technical analysis, you identify a potential buying opportunity at $150 per share. Now, it's time to implement your risk management strategy by setting a stop-loss order. Based on your analysis of the stock's recent price action, you identify a support level at $145. To protect your capital from significant losses, you decide to set your stop-loss order at $144, just below the support level. If the market turns against your analysis, and the stock price drops to $144 or below, your stop-loss order will be triggered. This will automatically sell your shares at the market price, limiting your loss to $6 per share. This example highlights how a stop-loss order acts as a safety net, protecting your capital from substantial losses when a trade goes against your prediction. Introducing take-profit orders, securing your profits. While stop-loss orders are essential for managing risk, take-profit orders are equally crucial for securing profits when a trade goes in your favor. A take-profit order automatically closes your position when the price of the asset reaches a predetermined level. When a trade is moving in your favor, it can be tempting to hold on for even greater profits. However, greed can be detrimental, as market sentiment can shift quickly, leading to a potential reversal that could erode your gains. Take profit orders instill discipline in your trading by automatically locking in profits at your desired level. This ensures that you capitalize on successful trades and avoid the regret of watching your profits dwindle away due to indecision or greed. Implementing take-profit orders. Determining the optimal exit point. Determining the appropriate take-profit price is just as crucial as setting the right stop-loss level. It involves identifying a realistic profit target based on your market analysis, risk appetite, and the asset's volatility. One common approach is to use technical analysis to identify key resistance levels. For long positions, traders might set their take-profit orders just below a significant resistance level, anticipating that the price might retrace from this point. Another method involves using a risk-reward ratio. This involves setting a profit target that is a multiple of the potential loss defined by the stop-loss order. The choice of take-profit placement depends on the trader's individual trading style, risk tolerance, and market conditions. Finding the right balance between securing profits and allowing your trades room to run is key to maximizing your trading results. Stop loss versus take profit, balancing risk and reward. While stop loss and take profit orders serve distinct purposes, they are both essential components of a comprehensive trading plan. They work in tandem to manage risk and secure profits, contributing to a more disciplined and potentially profitable trading approach. Stop-loss orders are primarily focused on risk mitigation. They act as a safety net, limiting potential losses on a trade and protecting your capital from significant drawdowns. Take-profit orders, on the other hand, are geared towards capitalizing on successful trades. They allow traders to secure profits at predetermined levels, ensuring they don't miss out on gains due to indecision or greed. By automating the profit-taking process, take-profit orders help traders stick to their trading plan and avoid making impulsive decisions based on emotions. Prioritizing one over the other depends on individual trading styles and risk tolerance. The power of combining stop-loss and take-profit. The true power of stop-loss and take-profit orders lies in their combined use. When implemented together, these order types create a comprehensive risk management framework that can significantly enhance your trading performance. By setting both a stop-loss and a take-profit order for each trade, you define your risk tolerance and profit target in advance, removing emotional biases from your trading decisions. This systematic approach allows you to trade with greater confidence, knowing that your capital is protected and your profits are secured. Combining stop-loss and take-profit orders also allows you to implement a consistent trading strategy. This disciplined approach helps you avoid impulsive decisions and stick to your trading plan, even during periods of market volatility. By automating your exit points, you no longer need to constantly monitor your trades, allowing you to focus on other aspects of your trading. Conclusion. Implementing a sound trading strategy. Mastering the use of stop-loss and take-profit orders is essential for any trader seeking consistent success in the financial markets. These powerful risk management tools provide a structured framework for managing risk, securing profits, and navigating the unpredictable nature of the markets. Trading involves inherent risks, and no strategy can guarantee profits or eliminate losses entirely. However, by implementing a disciplined approach to risk management using stop-loss and take-profit orders, you can significantly increase your chances of success. Make it a priority to experiment with different stop-loss and take-profit placement methods, back-testing your strategies, and refining your approach based on your individual trading style and risk tolerance. By incorporating these essential risk management tools into your trading arsenal, you can trade with greater confidence, knowing that you have a plan in place to navigate the ever-changing dynamics of the financial markets. Please like, share and subscribe to our channel for more insightful trading tips and strategies.